Hey guys, welcome back to my channel. Today we're talking about something different. Today we're going to be talking about my options strategy, which is something that I've been doing for a bit now. And I want to talk a little bit about the basics of the strategy. And I do know that a lot of people who watch my channel are regularly tuning in because I trade things like gold and the indices and the currency pairs that I talk about so often on the channel. Today's video is going to be a little bit different, so feel free to stick around and check out another side of my portfolio of different trading strategies and investments that I personally do. So before we dive into this strategy, quick risk disclaimer: trading options, just like everything else, can be very risky if you don't know what you're doing. So please proceed with caution with this video. This is not financial advice. I encourage you to do your own due diligence and speak with a financial advisor before you get involved with any sort of trading or investment stuff. And in this video, I'm going to be sharing my opinions for educational purposes. So let's jump in. So selling options for premium, it's a high winning rate, meaning I win a very high frequency of my trades here with relative low risk. Now, again, we'll jump into the specifics. Let's get into it. So in terms of options, if you're not familiar, many of my viewers may not be very familiar with options. So I encourage you to do your own homework, do your due diligence as always. Let's talk about this. So before we get started, you'll need to know some of the basics. What is a call? What is a put? What is premium? What are strike prices and expiration dates? This is, of course, the core basics of options. Now, quick basics here. Call options are financial contracts that give the option buyer the right, but not the obligation, to buy a stock, bond, commodity, or other asset or instrument at a specified price within a specified time period. Now, I know that was a lot, and it'll make more sense as we get into this, but you could also pause the video and check out more details about what calls and puts are if you would like. But let's reverse it. A put is basically a bet that you think the market will go down. So a call is a bet that you think the market will go up. So if you're looking at GLD, which is an ETF that tracks gold, if you think it's going to go up, you might choose to buy calls. If you think it's going to go down, you might choose to buy puts. A put option, or put, is a contract giving the option buyer the right, but not the obligation, to sell or sell short a specified amount of an underlying security at a predetermined price within a specific time frame. So why would you want to buy these things? Well, if you buy a put or you buy a call, again, it is essentially somewhat of a leveraged bet that you think something is going to go up or down in a financial security, whether it's an ETF, a stock, a bond, whatever, right? So let's keep going here. And I want to talk about the contracts here and everything that it means. So when someone buys or sells a put or a call, the buyer of the option pays a premium, and the seller of that put or call contract receives a premium. So when you buy a put or you sell a call or any transaction, there's always a buyer and there's a seller. And these are two individuals trading through a brokerage where they're able to trade options or essentially, it's like, think of it as signing a contract between two traders. So the buyer pays a premium and the seller collects a premium. And if you've ever purchased puts or calls, you'll recall paying the premium up front. So when you purchase the option, you pay what is referred to as the premium as the buyer. So why would anyone want to buy a put or a call? If you're paying premium just to take the position, why would someone want to do this? Well, here's a couple reasons. So why buy an option? First, they may be hedging their existing position by purchasing a put or a call against it. I have a good friend who trades and invests in stocks, and oftentimes when things look really concerning or there's a huge announcement set to come out, he will actually buy a put or buy a call to simply hedge his position. So for example, if you own 100 shares of Apple, but you think that something could be coming that could cause the market to sink, perhaps you maybe take you pick up or buy a put option, meaning you pay some premium in order to have essentially insurance. So many times traders will use options as sort of an insurance policy, and you as the seller of that option would be the insurance company. You're selling options in the effort of collecting premium, or if you're the buyer, you're perhaps just somebody who has a position on a stock or an ETF or a bond or whatever, and you just want to hedge or insure your position in case things sell off a cliff. So yeah, there's oftentimes that situation. Number two is they may be doing some more advanced option strategies which involve buying and selling options at the same time. Some traders will do all sorts of different combinations of buying a put and perhaps selling another put at a different strike price. There's all sorts of strategies out there for options, which we won't be getting to in this video. Today's strategy is relatively simple, and my trading knowledge with options is admittedly much lower than it is in other areas of my trading, but it's something that this strategy is simple enough for me to understand, simple enough for me to implement, and I've been doing it for a bit now. So let's talk further about number three. Number three is surprisingly a lot of people. A lot of people simply use options as a way to leverage their account substantially, and again, basically do a highly leveraged bet. Now, one thing you'll need to know, and we'll talk about this, is that when you buy an options contract, a single contract is 100 shares of a security or asset. So of course, if the share price is $200 and you're buying an option, that's $200 times 100 shares of that underlying asset. So as you can see, it gets to be a pretty substantial amount of money. And so a lot of times, traders out there who are using options are simply using it to leverage themselves and to trade very high positions. I'm very much against this. I think that, using a lot of leverage is a quick way to lose a lot of money when it comes to trading, whether it's Forex, options, futures, doesn't matter. I think trading with a lot of leverage is a really risky way to approach the markets and not something that I personally do. So again, I personally prefer to be on the sell side of options. Also, I should pause here for just a moment to let you guys know, if you are looking to trade options or learn more about them, I encourage you to check out the brokers linked down below in the description. Both of these are great options, whether you're inside or outside of the United States, you can still trade options. So again, down below in the description, there will be information on these two brokers that I've got listed for you. So if you're in the US, I personally recommend Webull. This is what I trade my options on. It's a great brokerage, super easy to use, and what I would say to be the best platform in terms of usability. User interface is really easy to use, especially to newcomers to the options world. Check out Webull, linked down below in the description. At the same time, for my friends outside of the US, you're not left out in the cold. There is actually a way for you to trade options as well, using the brokerage that's listed down below called Interactive Brokers. This is another brokerage that I have an account with. I don't trade options on this one, but it is an option for options trading for those of you guys who are outside of the US. Let's talk about the strategy. So again, remember, as the seller, you collect premium just to offer someone else that insurance that they want to purchase for themselves. You essentially take the other side of that situation. So for me, I am looking to sell what is called out of the money, or OTM, puts and calls for premium. So what this means is that essentially, let's say that something is trading at $110 and I sell a put to someone at $100, meaning they have the right to buy those shares at $100 per contract. And I have to take the other side of that trade. So of course there are inherent risks, which we'll get to, but as a seller, I want options to expire worthless. Now remember, there's an expiration date to options, and we're gonna get into an example. So if this is sounding a lot, just bear with me. We'll get to an example, which I think will make sense. And also, if you're enjoying the video, do me a quick favor, hit that thumbs up button. Options are not something that I've commonly spoken about on my channel. They are something I'm very interested in and do myself. But again, I hope that I'm going at a good pace and that this is making sense so far. Feel free to rewatch parts of this video if you need to. So if I sell a put and price stays above my strike price, remember there's a strike price involved with the contract and there's an expiration date involved with the contract. If I sell someone else a put and price stays above that strike price at expiration, or up until and through expiration, I collect premium and I don't have any obligation to buy the shares. So there's plenty of situations in which I sell someone a put, price never goes underneath that strike price or even to that strike price, and I just simply collect painless, no hassle premium on my position or my contract, and the buyer of that contract again essentially loses all the money they paid in premium, and I again collect it. So if I sell a put and price travels, however, at or under the strike price, things get interesting because I may be assigned the shares by the options contract buyer. So let's get into some examples. So before we get into an example though, I want to say a couple things about this strategy. I stick to assets I wouldn't mind owning forever. And this is going to be apparent in a moment when I talk about this, because again, if you get assigned shares in lots of 100 shares, you can clearly see how you may be landing with a big position as the options seller. And if you don't want a big position, you probably shouldn't do the strategy that I'm talking about, because this strategy inevitably will land you with a good sized position in something. So I stick stick to a couple things that I really wouldn't mind owning for a long-term period of time. So for example, SLV, which is a silver ETF, DIA, which is the Dow Jones Industrial Average, KO is an example, Coca-Cola. I've sold puts on Coca-Cola. We'll talk about, again, examples in a moment, IWM, which is the Russell 2000, etc. So this is key because, again, if I sell puts and get assigned in the event price goes under my strike price or to my strike price, I will be owning these shares or assets at this price. So I want to make sure that I'm actually okay owning them. I don't want to be assigned shares unless I wouldn't mind owning them. So again, that disclaimer out of the way, let's talk about an example. So this is a real trade that I took. And again, I mentioned options trading is something that I am learning about myself. This is not something I would say I'm a super established professional by any means. But I've been trading for a long time. Options is something I am comfortable doing. I know the risks and I know my strategy here. It's something that I'm at this point I've tested, I've gone through with, and I'm at a point where I'm very comfortable doing this over and over again. And again, it could be some great way just to collect sort of low, high probability cash flow on an account. So anyways, let's keep going. So on June 17th, this is when I sold these contracts. I sold 3 put contracts. So I sold 3 puts, 3 contracts, essentially. And at the time, SLV was trading at $22 per share. So when I executed price, it was trading at $22, and I set a strike price at $21.50. Meaning that, again, if this put gets assigned, meaning price goes down on me, then I end up having to own the shares at $21.50, regardless of where the buyer of this put executes their right to purchase the shares, purchase the shares at $21.50. So I have to buy those shares at $21.50 no matter where it's trading. So if it's trading at $19, if the price of SLV gaps down tremendously and suddenly it's trading at $19 per share, I still have to buy the shares at $21.50. So you can see there are inherent risks here. And again, we'll talk about that in a moment. The expiration date I chose was about 30 or so days out, just a little bit over 30 days, July 21st. And I collected $120.17 just for writing this contract to someone else. Selling, writing, these two phrases are used interchangeably when talking about selling a put or a call. So I collected $120 in premium just for writing this contract, these contracts to the buyer of this put. So again, there are some things here. So let's talk about what would happen either way. Now, this contract has not finished yet. So at the time of recording this is still going on. So if price remains above $21.50 at expiration, again, that July 21st, was it? Yep, July 21st expiration date. If price remains above $21.50 at expiration, I simply collect premium and I'm not required to buy any shares. So I keep my full $120.17 in premium, and I'm able to repeat the process. So if things just shoot up on silver, awesome. I collect $120.17 in premium, and that's about all I have to do. I don't own the shares, and this contract will expire worthless, meaning the put buyer is unable to exercise their right by any means, because again, we never went underneath the strike price. Ideally, in the case that I'm selling options for premium, I can just do this every month, and I can collect premium for doing so. But we need to talk about what I had to do in order to make this profit or this collection of premium. So again, ideally price would move higher and I have income from collecting premium. So this is the idea, is you essentially want to sell puts on something that you're actually bullish on and you think will go up. Because if it goes down, we have to talk about scenario number 2. So if price trades at or under $21.50 anytime before expiration date, I may be required by the put buyer to buy the 300 shares from them at the agreed price of $21.50. Now you may be asking, why 300? Well, remember I sold 3 contracts. So as I mentioned earlier, each contract is 100 shares. So I sold 3 contracts, 3 puts, right? So 300 shares, each contract is 100 shares. So if this happens, I of course would then be holding a pretty good sized position, right? $6,450, because I would have to buy the shares, 300 shares times $21.50 per share, which again comes out to $6,450. $6,450. So I still, though, in this situation, even if I get assigned the shares, even if the market goes down, I still collect my $120.17 in premium. Once you collect that premium, the buyer doesn't take it back at any point. They paid that. That is the insurance essentially payment that they made, and you collect it as the insurance company in this situation. So we need to talk about this situation though, because you might be saying, well, Nick, now you have a ginormous position in silver. Well, it just depends your account size, of course. I'm operating on a larger capital basis, which we'll talk about capital size for these sorts of strategies in a moment. But at that point, my shares do, at the point that my shares do get assigned, which is not a question of if or it's a question of when. There are times in this strategy where you're simply going to get assigned. The market does not always go straight up. And so there are times where you get assigned the shares. Now the fun begins, because you have to make a few decisions with what you want to do now that you own these shares. So if you sold the puts, you collected the premium. If the market goes up, great, you don't have to do anything. But if the market tanks, now you have to think about some things. So I have a few options. First, I could just hold the shares and simply wait for price to rise and sell the shares once they go up in value. So again, I got assigned these shares. Now I no longer have a contract open with anybody, but now I just own the shares at $21.50. So if the price moves up to $23 and I'm in a profit, perhaps I just close out the position. Or I could just close them out for a loss if I wanted to, if price is trading underneath my entry, so on and so forth. That's up to you. If you just want to do it the old-fashioned way, close out of your position or hold it till profit, if it's able to get back into profit. However, there's other options. I could continue to hold the shares, but again, sell out of the money put to collect more premium and build a bigger position. So let's say that I get assigned these shares and suddenly I own a position in SLV or silver. It's a silver tracking ETF. Okay, let's say I now own the position and I want to just sell puts again. I could sell out of the money puts and repeat the process if I'm willing to build a bigger position. And again, that's the key there. You have to sell puts with, again, the agreement that you will buy more shares if that's something you want to do. So that's another option. And then finally, I can now even begin selling calls on my shares and collect premium on them, known as covered calls. If you made it this far in the video and you would like me to go into covered calls, do me a quick favor and comment down the word covered calls, and I'll try and make a video about that in the future. I'm not really sure how well options will do on my channel in terms of talking about them, but if this is something that interests you and you'd like me to do more videos on them, comment the word covered calls down below. Again, this is the idea of flipping this around and actually selling calls on your existing position, called a covered call. Now, again, that is something that we'll have to talk about in another video, but today we're talking about the simple basics of this concept of just selling puts on something you don't mind owning yourself. Now, first of all, I want to say, if you guys would like to keep up with the options alerts that I actually trade, I share them inside of our Discord channel. So if you're a gold member with us, you'll already have seen these, but you can actually see every position that I take in form of an options trade. Now, again, I am mostly just on the sell side of options. I sell options or write options for premium, but within the group, you'll also get access to the chat rooms, the coaching webinars, and of course, all of my trade alerts, not just the options, but of course, the other things that we do, which are indices, currency pairs, all sorts of other things, gold, oil, that sort of stuff. Myself and of course, my trading companions within the group, where you can see the trades that we're all taking in the form of alerts. So you can sign up below, and if you would like to, you get access to this stuff for a subscriber discount for watching this video. Just punch in the code YTVIP when you are signing up, and you can get access to the group for a discounted rate by using that code. So let's talk about the pros and cons. Again, we went through an example with SLV, and there's some clear pros and some obvious cons that we have to talk about as well. So the pros are pretty straightforward. There's a high win rate, and this should be another bullet point, sorry for that. The next one is it's less concerned with timing, and this is more sort of for me, a little bit of a longer term position trading style, where I don't mind holding the shares for a while. If I get assigned, I may be willing to work with the position. It's a pretty flexible position style, or style of building a position on something. And it's also relatively simple. Now, I know some of you guys who are newer to options might be a bit confused by this concept. And again, I encourage you to watch this video back if you need to. but it's a relatively simple strategy to execute once you get to know the ins and outs of options. And it only requires a few actions a month. It's really a quite simple strategy in the form of execution. You only need to look at these things a few times, especially when you're doing what I do, which is I typically sell options that are 30 days out, and a strike price of around a delta of 0.3, which perhaps we can go into a more detailed video about that. But again, I'm generally setting up options contracts. I'm selling options out of the money, and I'm selling them at places that I wouldn't mind buying them myself. It's almost like setting a limit order and getting paid in premium just to set that limit order. It's quite cool in that regards. So there are inherent slight advantages for selling for premium. As most options do actually degrade in value, they typically expire worthless due to the fact that time decay on options actually offers you some profit potential just from the way that options tend to lose their value over time. If you haven't gotten to know these concepts, again, I encourage you to do more research on options. Options over time lose their value, and if you're shorting or selling those options in the form of writing a contract for another trader, again, it could be a nice way to make some money in that way. Now, of course, there's cons as well. It requires a larger capital size because, again, sometimes you're going to get assigned these shares, and that could be upwards of $10,000 of a position or $20,000. Just depends what you're trading. The higher the price of the underlying stock or ETF or bond or something, the higher that per contract 100 shares is going to cost you in order to purchase it in the case that you get assigned the shares. So it can be very risky on more volatile assets, which we'll talk about in a moment. Some assets have really high premiums that they'll offer for you to sell them, like higher risk stocks, like even things like Tesla, which are very volatile in nature. And I'm going to tell you about a nightmare example or a bad example of this in a moment. Also, it performs pretty bad when the market is tanking. If the market's just selling off and you're just getting assigned constantly on your puts, that could be a little bit of a tough time, and you want to make sure that you really do want to own the underlying asset before you sell a put on it. So let's talk about the pro tip. So again, avoid high risk assets with this strategy. Cheap stocks can offer deceivingly attractive premiums. This strategy can land you with a big size position if you continue to sell puts on the way down, and I only employ the strategy on very stable individual stocks or ETFs I wouldn't mind holding onto for the long term. Let's show an example of ticker symbol LYFT, which is Lyft, which is the, again, competitor to Uber that has been performing really poorly. So what you're looking at here is the share price over the last year or two. And if you see these green bars, had you picked up or sold puts at these strike prices, you would have gotten assigned all the way down. And this would have landed you with a very large position in Lyft. And if you think about it, if you were buying up at 63.74 and 59 and 51.78, clearly you can see that this would have landed you a ginormous position in something that tanked all the way down to under $8 per share. So as you can see, there's some serious risk to this if you buy into something or sell puts on something that goes really poorly. So for me, this is why I inherently stick to safer bets like the S&P 500, perhaps silver. Now, of course, there are risks with these things as well, so I'm not saying they're riskless. They still have risk. You may still land a big position, but you better be happy owning these things for the longer term because you very well might land with a pretty good sized position in the meantime. Quick reminder, guys, if you would like to learn more and you would like to see the trades that I'm taking in the options world, feel free to join our community, which will be linked down below in the description. Hey, guess what? I just found a video made just for you. Click this video to help with your trading, and thanks for watching.